Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about labor data, falling mortgage rates, and what the Fed might do next. Logan, welcome back to the podcast.
It is wonderful to be here on Jobs Week, and we had so much fun at the U.S. Bank Conference, and we highlighted, we said, what fortuitous timing, because we gave everyone like labor data to focus on, like we've written in our articles and everything, and here we are. The 10-year yield is at 4.29, 4.30. That's a very key level. We've had a really big move lower from 4.63 now here, and we have claims that are going to come out when this podcast come out, and then jobs Friday. But one thing is constant is that the labor market has been getting softer for many months now, and the Fed has kind of somewhat held back from saying that. So has the Fed lost the labor market argument?
Yeah, so this is so what are the reports that you're looking at that make you think that?
Okay, so number one, the Fed talks about job openings a lot, right? That's their whole thing. Our whole COVID-19 recovery model, switching it to the labor market, said, hey, listen, we're going to get 10 million job openings in this cycle. We got 12 million. The Fed, to me, again, paper, rock, scissors, we take labor over inflation data. That's more important for rates, and for rates to go lower and stay lower. That's why the last 2 years, the Gandalf line, everything was set and designed not for mortgage rates to break or stay low. But here, the job openings data is all the way down to 8.1 million, right? So what's occurred is whenever you have that many job openings declining, you're usually in a recession, but we're from an elevated level. To me personally, whether people agree with this or not, the Fed wants job openings getting down to 7 million. Okay, remember, they want the labor market to break for their cover to cut rates. Canada just cut interest rates. They're the first G7 country to do that this morning. So now down to 8.1 million, but they would say, hey, listen, job openings are very healthy. Well, I would argue that the quits data has shown that not only the labor market has gotten softer, but technically the unemployment rate is really higher. And for those that lose their jobs, it's a little bit harder to find one. So right now, any Federal Reserve member that says the labor market is tight is a fraud. It's not tight anymore. It's tight only in relationships to the data line you believe, or if financial conditions were easing that the labor market can grow. No, it's not. It's not. The labor market has been slowly deteriorating for some time, but now we're starting to get to really, really interesting levels. So job openings, 8.1 million, quits ratios are pre-COVID. The hires are pre-COVID. The unemployed versus, the unemployment levels per how many people are looking for jobs. All these things are kind of pre-COVID levels. And they themselves, whether we agree with this or not, they believe they are having restrictive policy. So all that matters is what they believe in, not any of us. I know some people say financial conditions are not tight. Some people say financial conditions are too, whatever it is, they believe the Fed funds rate and rates are restrictive policy. Of course, we all see it in housing. It's the third calendar year of the lowest home sales ever recorded in history. So now we're getting to the spot where, what if the headline jobs numbers start to slow down? Then the unemployment rate gets up. My argument is that the Fed will be very restrictive in their own minds. They will talk up financial conditions to be tighter, like we've seen them do, until we see a break. And I think the last data line for that to happen is jobless claims. And now we know this, as the Federal Reserve has talked about. Listen, we watch jobless claims, and jobless claims have been going lower. Once now everyone can realize that why I had that 323,000 number back in 2022. Once you start heading into that area, the 10-year yield and mortgage rates will already be going lower, right? And then the Fed, by nature, old and slow, is going to be behind the curve. That's just how the process works. So the question is, have they already lost a tight argument? Can they literally go up at the Fed meetings now and say the labor market is really tight in that sense? My argument has been for some time, no, they can't. If they want to say, well, we need to have a job loss recession so we can make sure that entrenched inflation doesn't happen, or we want to get to our 2% goal, and we believe that will not allow companies to keep raising prices at a level that is not or is unhealthy in their own mind. So I think we have enough data to talk about this, and also the wage growth data for me is really important. We're almost getting down toward the 3.5-3% level where we could start saying that's another thing we can take away from the Fed as well. So they could be proactive and get ahead of the curve. My argument is that they don't want to, and even if they cut rates 3 times, it doesn't matter because based on their own models, they're still restricted.
So interesting to me. Hold on. I just totally lost my train of thought. I had this great train of thought. Hang on. Okay, I got it again. So does the Fed care at all about what kinds of jobs are being lost? Is it just a total number for them?
They don't care. Okay, so I'm going to use this example because if you look at the credit data, we have rising credit card delinquencies, rising auto loan delinquencies. Neil Kashkari goes, I'm keeping an eye on it. I'm keeping an eye on it. You know, I am. No, you're not. You don't care. Fed doesn't care. So the Fed comes out there. Jerome Powell, next time he comes out there and talks at the Fed meeting, says we need to help the people that are lower incomes because lower income people are getting hurt because the credit data is really impacting them. So they're the ones that are having the credit deterioration. Low income single household renters, those households are getting hit harder. And that's where the credit stress is. They don't care. If they did, they would say the credit deterioration we find to be very, very troublesome as auto loans and credit card delinquencies have been rising, and we want to make sure to get ahead. They don't say that. There's a reason for that. They want the labor market to break, right? Because they're running old Fed models that doesn't adjust to, like I always say, like homeowners. What do we always talk about? Like people are worried about homeowners, right? They're worried about this, and it's just in scale, it's just not the case. But we see credit deterioration with lower incomes and young renters, and it's just not in their it's not in their mode to start being dovish yet. But once the labor market starts to break, my assumption is that they will welcome long-term yields coming down and then doing the heavy lifting for them early on. And then they'll start cutting rates and changing everything, but not yet because the labor market hasn't broken. Claims haven't breaking higher. And like Jerome Powell has said, like Bostic and everybody says, labor data hasn't, we've been watching that. And because it's tight, we could still be restrictive. Once it breaks, they will fold. The market will fold and then kind of bring them with them. But we're getting to really, really key levels on the labor data that even they can't. I mean, maybe they can. Maybe they come up to the public and lie and say the labor market is still tight. So it's more interesting this year than last year. Last year was the Gandalf line had to be created. Labor market isn't breaking. It's not. We have a lot of leeway to do. And again, to me, it's like when we get 157 to 159 million people employed non-farm payroll, the job growth data should slow between 140 to 160. That hasn't happened yet with any duration. So we're getting to those levels. So I'm very interested to see how the labor data changes the Fed language now that job openings, their holy grail, is now near 8 million. I think once they get to 7, boy, they can't do that anymore, right? Once they get 3% wage growth, they can't do that anymore. So it's more interesting on that front. And again, we have Jobs Friday, and Jobs Friday is just one report. All I care about is a trend, and the trend has gone one way for some time now.
No, I at the U.S. Bank event, you had the series of charts where you were like, here's this inflation chart, here's this wage growth chart, here's this, all of the things that the Fed would use in this decision making are all trending one way. I thought it was very powerful.
Yeah, and in this week's shows, we talked about this in the tracker on Saturday. This is a big week, right? Because the labor market is getting softer, and here's Jobs Week, and if it happens, the 10-year yield should go lower, and it has, and we're at a key technical level. So we'll see. Does the BLS Friday jobs report keep it going, where the Fed could be restrictive for longer, or does that report in itself keep it going? And remember, 2 to 3 times a year, there's always misses on the jobs reports, and 2 to 3 times a year, you always have some beats. But the trend is more important, and the trend is heading one way. My argument has been they will not pivot until the labor market breaks. if it was any other time in history, the Fed would have already been cutting rates, right? But in this case, I feel like they feel more confident when the labor market breaks that they can go into their dual mandate. And they've said this. We literally repeat the Fed's language, and people go, Logan, the Fed doesn't attack wages. Waller, wages are too high. We got to attack that. We got to bring that down. Fed, they're not waiting for the labor market to break. Oh, the labor market is still resilient, and that's why we're restrictive. I mean, literally, they're telling you this in their weekly press meetings. So, but we're getting down. I mean, trend is your friend. You take all the aggregate data together, we put them all together, and look where we're going. We're going to one direction, not the opposite. And wage growth has been kind of slowing since 2022, right? The whole entrenched inflation of wages are going to go spiraling out of control. It's 2024 now, right? We're almost kind of toward the Fed's goal on that as well.
It's almost like we just need to get into this recession and get it over with, get it out of our system. Because if you look at the people on the street, they feel like there's a recession because of prices being high, all that kind of stuff. It's almost like we just need to get it over with.
I'm not a big fan of that mindset. I know Neil Kashkari talked about that, where people said people would rather have a recession, than, to bring inflation down. And let me take that side of the argument right now.
Okay.
Because people believe like recession is like major deflationary where prices, go down significantly and stay lower, right? The history of deflation is not prevalent here. Home prices collapsed during the housing bubble crash. That's a whole different story, but it's not like rent inflation like went back to the early 1980s, because why? Majority of people are all working. So the counter to this take is that, well, most people are always working, so we have pawns that we can sacrifice in every recession just to bring the growth rate of inflation down. So because majority of the people will benefit with a disinflation tactic, a recession is needed. Now, I could argue that this is what the Fed's kind of thinking, right? That if we have a mild recession, companies can't, push pricing on, and then all of a sudden, things will get more into balance. But, economic cycles come and go. We have recessions always, but a full employment economic cycle is the best kind of employment, because everybody's working, and when everybody's working, wages go up and people consume. And when you have unemployment, right, like majority of the country is working, right? That's the goal. And you don't want to say, let's have a recession just to get a little disinflation in the data, and then all of a sudden it goes back up again. So supply is always the best way to deal with inflation on all fronts. But here we're dealing with a lot of interesting supply issues post-COVID, of course. I mean, a lot of it early on was COVID related, and now still we're trying to work our way back up for inventory just to get back to a more healthy level. Because, I had somebody on Twitter say, well, inventory is starting to get back up to 2019, but demand isn't. I said, listen, if people haven't figured out by now that I'm a very pro-supply person, it's because even mortgage rates getting down to 6% in 2023, kept the inventory data from growing. And we had near 6% home price growth gains in a year where we trended at the lowest home sales ever recorded in history, and rates went from 6 to 8%. Supply-driven markets are not very healthy because the prices can, rise at a faster rate than is needed, and that impacts demand going out. So I just want a level playing field, and 2019 inventory is it. So in that case, supply things, there's only certain things that the Fed could do. And unfortunately, we're starting to see that some of the apartment data, the disinflation that we're seeing in apartments, is now starting to slow down, and we're seeing the occupancy rate grow. But the problem is now apartment permits are at recession lows, and it's going to take time to get that going up. So it's not a very easy situation to fix, but we have to take it one day at a time and find ways to get more supply, because that's the best way to deal with inflation.
It's funny because people accuse you of all kinds of things, but especially in the economic world, they're like, oh, you're a permeable, or you always, you're a shill for housing or whatever. And actually, I know that what you really want is like this balanced market. That's what you were team higher rates when no one wanted higher rates because you're like, we have to have more inventory. So I think it's funny.
The only people who do that are anti-central bank people. And these are fanatics. And I had to, we have this whole tactic now where we challenge people to live debates because I want your name and face. I want your children to see you. I want your spouses to see you. I want your coworkers to, and I want to see your models and forecasts. And I know you can't do it. I know it. I can see it. But if I could get a whole country to see what a bunch of fraudulent grifters, this is America. Like somebody calls you out and you're like all talking and then all of a sudden you hide. Oh no. You can't do that here. This is the United States of America. So the trick was to try to get these people as many live debates and then get their forecast. They can't do it. We knocked one out yesterday too. So the smart ones figured out what I was doing in 2022. So they just kind of kept quiet. But we always get rookie ball people that think they're housing experts. I'm a housing expert. Can I see your forecast? I don't do that. Can I see your name? No. You're an expert. So the whole thing is to destroy as many of these people while I'm alive. Cycles come and go. Economic cycles come and go. Pricing. We have models. We track everything. But this clan, no. I mean, I understand why Russia and China does it. I get it. They hate us. But you're living in this country and you're wasting your life doing this. Oh, you don't get a pass. And they're so used to like economists blocking them and they go, oh, look at this person blocked me. I will take every single one of them every day of my life until I am dead. Until I am dead, because I want your kids to see you for what you are. Basically trolling the United States of America. It's fine. But no more hiding. Men are brave. This is the U.S. We are brave men in this country. I don't ever go after women because that's not the right thing to do. But the men are all free game here.
Yes. Especially middle-aged stock traders tend to be your favorite target.
Stock traders, Jesus. They're need some antidepressant life. God, you talk about a bunch of angry people out there. Oh, the Fed ruins everything. Are you long stocks? Yes. You are? Wait a second. You're net long like 99.9% of your life and you're crying every single day about the Fed. Do you own a house? Yes. And you're still crying with your 2.75% mortgage? Oh my God. Argentina's going to get rid of the Fed. All of you, take a plane and go there. Voila. I'll go on the airport and, bye. See you guys later. Enjoy Argentina.
Oh my gosh. Okay. So what other reports are you looking at, keep an eye out for?
So again, by the time this podcast comes out, claims data and claims are bouncing on the 4-week moving average off of a low. So we want to see if that continues. Now that job openings data is lower, the quits percentage is lower, claims data gets a little bit more insightful now. Again, this is not 2023, 2024, right? So we need labor triggers to go into our recession mode. So I think claims is there. Purchase application data came out again. 1990s block party. We're still at record lows. And the reason I say record lows, you should never take a sales data adjusting to total population for housing because people live in their homes. They don't buy and sell homes every week like they go grocery shopping. But we have a lot of people now working and our demographics are good. So the fact that we are still here at 4 million, so remember, line in the sand has always been 4 million, right? If we break through that and we start heading, we are in total collapse mode in housing. But here we're just stuck, right? And I personally, I just don't. I've seen what the builders do. The builders can grow sales at sub 6% mortgage rates, but we're not there, and there's nothing yet to get me kind of below 5.75. But a few little green shoots. The spreads are getting better, and if the labor market gets softer, right, the 10-year yield could go down. And because the spreads have been bad for so long, and the 10-year yield has been elevated, if those two get together, you can kind of get toward your 6% level. And then if that occurs, then the sales growth that we have when we get to lower rates, we can hold those and keep them out there instead of, having 1 or 2 months of a big sales print and then just kind of coming back down. So we have people that want to buy. I just say that the total cost of housing got so high that we've killed a marginal home buyer. And it's not like, oh, I can buy a house. I just don't want to give up my 2.75% mortgage rate. It's a mortgage rate lockdown. No, they just literally can't afford it, because if you really needed to move, you would have moved already, right? But they don't, right? I just don't believe, I believe the affordability hit was so massive that it killed a lot of home buyers off the grids. And this is a time where we have a lot of people working in good demographics. That was a whole savagely unhealthy housing market. It's like, oh boy, we're in a bad spot after the summer of 2020. It's like, I still believe to this day that nobody understood how low active listings are and how good homeowners' financials were, and people don't sell to be homeless. It's really, I will always remember this period in time, the sell to be homeless thing. Like that is some good drugs you people are on, that people like actually do that. But this is where we are right now. So I'm very pro supply. That was a whole team higher rates. I believe inventory can grow if rates stay high enough, long enough. Weakness in demand takes the mortgage buyer out. The mortgage buyer takes that home off the market, and you could allow it to grow. The question is can the economy stay firm enough for that to happen? This is why I'm so happy about 2024, right? Because I'm creating somewhat of a buffer. Because if rates fall again, like it did at the end of 2022 to 2023, the inventory channels just don't have the ability to grow. We saw better growth in inventory toward the second half of 2023, but it took rates to get to 8%, right? So it's hard to do that if the economy is breaking down. So as long as the economy stays firm, you can still do this. But once that happens, then housing gets disproportionately hit to the positive side of things. So it is what it is. You know, we just deal with it one week at a time. And this is why it's really critical for housing people to track all economic data, all the variables put together. Because what do we do in that conference? The slow dance, Sarah. See, you got to get on stage with me, and then we could do like a little slow dance with the 10-year and then show. And then, you know, whenever the spreads get bad, we could back off from each other. And then when the spreads get good, and then we could do a live like slow dance, because that's what it is.
Oh my gosh. This sounds like you're hearkening back to your basketball coach days, and it's like a pep rally, and you're doing something like that. And yeah, no. Mm.
No, it's not a pep rally. We want to explain the relationship between the 10-year yield and 30-year mortgage rate. So I think what can happen as slow dance.
We do not need a visual
bad, the
of that.
slow dance partner gets away. Are you telling me you're not coordinated enough to do that?
Oh no. It's not that. Listen, I swing dance. So I'm
you love to
in
dance.
part.
I'm
I
just
do love
saying,
to
you talk about all this dancing. I said, it's just a slow dance with the 10-year yield chart and 30-year mortgage. Okay, I wasn't alive in 1971, but you were, so we can do that, right? You know?
1971. I think I remember 1971. I was kind of young, but oh my gosh. Okay. Well, Logan, we're going to end on that note. Thank you so much for being on. Thank you for doing the extra episode with us. People really appreciated that episode about why that CNN story was so far off base. We heard from lots of people who are like, thank you for calling that out, because, you know, it's infuriating when you're part of the industry and you know what's going on. And then you see that go out to your consumers and you're like, really?
You know, the CNN thing is it's part of this whole post 2008 mindset that if you say 2008, it triggers people. Like, you clicked on it because it said bubble era, you know, and in this day and age of needing engagement, doom porn sells, right? So it does. I mean, I've seen it for a long time. There are not many of us left in the world, Sarah, that try to fight this. But I realize I have to bring theatrics into my economics discussion to try to teach people. Like, my job,
theatrical?
I want to teach you.
What?
Yes, me theatrical. Yes, my old acting background kicks in sometimes. But I mean, this is the way to try to counteract doom porn, right? And again, trust me, a lot of these people will just admit it. Listen, I'm doing this just for engagement. I don't really, really. And that's just, a lot of these people, that's kind of how they make their livings or anything. Me, on the other hand, I am fortunate enough that I don't have to do that. I can still stay within the code and the rules. But that doesn't work if people don't listen. So we change things up a little bit just to make things entertaining and try to teach, right? I'm trying to teach economics. That's the old high school basketball coach and historian in me. We could teach models and teach people how to read and look at charts. Those beautiful charts. Like, for everyone knows, like, I literally, when I see the FICO charts in America, what do I do, Sarah?
You get a glass of something, you sit
Yeah,
there, you look at
I
it.
go,
Yeah.
it's 8 o'clock. This is the running thing. It's 8 o'clock at night. I got the FICO score charts up. I bring my cognac out. Next time I'm going to bring bourbon out. I get a little jazz music going. And then I took the charts on. It's so beautiful. It looks so beautiful. Like the countries around the world hate us because our homeowners look so good. Like one of the reasons why Canada cut rates is that, boy, they got a lot of ARM loans that are recasting over the next 2 years. And boy, they got those 90-year loan modification loans coming out. So we don't. We have a financial product that was very designed to fix debt cost and rising wages. So it created and spawned the best financial profiles ever in history. And the FICO score shows it, and nested equity show, all these things are positives for the U.S. consumers. We outperform the world and everything in that. And the FICO score data showed it. So it's beautiful. Like I just love it.
It is art to you. I love that. And thank you for sharing your perspective with us because it makes us smarter. So Logan, we will talk again in a few days. And when next time we talk, we will know what that labor data is.
Yeah, it'll be Jobs Friday. So Jobs Friday is big. Keep an eye on that 10-year yield right now, right? It's trying to break lower, but you're going to need a little bit more labor data weakness to get that down there.
All right. Talk to you soon.